As of Saturday, January 10, 2026, the stock market is currently closed for the weekend. Capital One Financial Corporation, trading under the ticker COF on the New York Stock Exchange, finished its last active session on Friday, January 9, 2026, at a closing price of $249.14 per share. This represented a notable intraday decline of 2.56%, or a drop of $6.54 from its previous levels. While the headline number might look like a simple case of Friday profit-taking, the reality under the surface is much more complex, especially as the company prepares for its high-stakes fourth-quarter earnings report coming up on January 22. Most investors looking at Capital One right now see a company that has successfully swallowed a giant in the form of Discover, turning itself into a credit card juggernaut that rivals the biggest names on Wall Street. The expectation is that this massive scale will lead to immediate, undisputed dominance. However, the deeper reality is that this integration is moving into its most difficult phase, and the market is starting to price in the friction that comes with merging two massive, distinct loan portfolios during a time of shifting interest rates and consumer fatigue. If you follow the narrative on social media or in retail trading circles, there is a clear tension between the buy-the-dip crowd and those who are growing increasingly nervous about the bank's exposure to the lower-end consumer. On platforms like X and Reddit, the frustration is palpable among those who bought in near the 52-week high of $259.64 just a few days ago, only to see the stock retreat back toward the $240 levels. Many retail investors are calling out what they perceive as institutional manipulation or stop-loss hunting by hedge funds, especially given that several major analysts from firms like Goldman Sachs and Wells Fargo just raised their price targets to as high as $300 and $280 respectively. There is a sense of disbelief that a stock with such glowing analyst reviews and a massive new acquisition could see a 2.5% slide in a single session without some behind-the-scenes selling pressure. But when you look at the trading volume, which hit over 3.8 million shares on Friday, higher than the three-month average of about 3.4 million, it is clear that institutional activity is driving this volatility. This isn't just retail panic, it is the smart money repositioning itself as they weigh the massive potential of the Discover payment network against the very real risks of a subprime credit slowdown. The common ground most investors share is the belief that the Discover acquisition, completed in May 2025, is a masterstroke. By owning the network that processes the transactions, Capital One isn't just a bank anymore, it is a direct competitor to Visa and MasterCard. This is the narrative that pushed the stock up nearly 40% over the last year. But here is the deeper take that the market is currently wrestling with. The closed-loop model only works if the volume remains high and the credit quality stays stable. While the acquisition has given Capital One an incredible 8.36% net interest margin, which is the envy of the regional banking world, it has also massively increased its sensitivity to the health of the American middle class. Retail sentiment is currently split. There are the permabulls who believe the synergy between Capital One's tech-first approach and Discover's loyal customer base will lead to a massive earnings beat. Then there are the skeptics who are watching the rising provision for credit losses, which, despite a release in the third quarter, still looms large at $2.7 billion. Traders are essentially playing a game of chicken with the upcoming earnings report, wondering if the bank will signal a need to set aside more billions for rainy day defaults. The institutional positioning right now is fascinating because it suggests they are taking a show-me attitude. We have seen significant outflows from some of the major financial sector ETFs recently, including the KBWB and XLF, which often act as a drag on individual components like COF. Behind the scenes, hedge funds are likely looking at the technical double top near $260 and deciding that the risk-reward ratio favors waiting for a deeper pullback. This creates a psychological trap for retail investors. When the media headlines are screaming about price targets of $300, it feels like a safe bet, but the actual trading data shows that the volume on the down days is consistently outstripping the volume on the up days. This is a classic indicator of institutional distribution, meaning the big players are slowly offloading shares to eager retail buyers who are focused on the long-term discover story while ignoring the short-term technical deterioration. Comment below how many shares of Capital One you currently hold, or if you're waiting for a specific price point to enter the stock. To understand where Capital One is going, we have to look at what they actually do and how their business model has shifted. Traditionally, Capital One was the king of near-prime and subprime lending, the people that Chase or Goldman Sachs might turn away. They used heavy data analytics to price risk better than anyone else. Today, they are a massive financial holding company with over $660 billion in assets and a deposit base of nearly $470 billion. Their business is split into three main buckets: credit cards, consumer banking, mostly auto loans, and commercial banking. The credit card segment is the engine, making up the vast majority of their revenue and profits. Before the Discover deal, they were essentially a middleman, paying fees to Visa and MasterCard for every swipe. Now they own the rails. This allows them to capture the merchant fees that used to go to the network providers. It's a brilliant strategy on paper, but integrating a global payment network is an operational mountain that hasn't fully been climbed yet. This is where the tension lies. The market expects the efficiency of a fintech, but the reality is the heavy, slow integration of a legacy banking infrastructure. Recent stock movement has been a direct reflection of this tug of war. After hitting all-time highs earlier in January, the stock has started to show signs of exhaustion. The daily swings are becoming more violent, which usually happens when the narrative is no longer enough to support the price and investors are looking for hard data. We saw a similar pattern back in late 2025, where the stock rallied 34% on hope, only to move sideways for weeks as investors waited for the Q3 numbers. When those numbers came in, showing an adjusted EPS of $5.95, which smashed the $4.20 estimate, the stock gapped up. Now, for the upcoming Q4 report, the consensus is an EPS of $4.07. That is a massive 31.7% increase year over year. The reality needs to not just meet that, but exceed it significantly to justify the current valuation, which sits at a price-to-earnings ratio that looks stretched compared to historical norms. If they beat, the $300 price target becomes a reality. If they even slightly miss or provide cautious guidance regarding the normalization of credit card defaults, the pullback could be swift and painful, potentially retesting the $220 levels where the 50-day moving average currently sits. There is also the macroeconomic pressure to consider. With the new administration's proposed budget plans and the potential for deepening deficits, the higher-for-longer interest rate environment is a double-edged sword for Capital One. For one thing, higher rates mean they can charge more on their credit card balances, often upwards of 25 or 30%. On the other hand, it puts immense pressure on the consumer's ability to pay. The retail community is rightfully frustrated by the lack of clarity here. On forums, you see traders posting about their own rising credit card bills as a boots-on-the-ground indicator that Capital One might be in trouble. This disbelief in the official soft landing narrative is a major driver of the bearish sentiment that crops up every time the stock dips. Institutional activity, however, tells a slightly different story. They are watching the net charge-off rates like hawks. As long as those stay within a manageable range, around 5 to 6% for the domestic card business, the big banks are happy to keep collecting those high interest payments. Looking toward the future, the scenarios for Capital One are stark depending on which side of the expectation versus reality fence you sit on. In the bullish scenario, the integration of the Discover network goes flawlessly, and Capital One begins to lure high-spending transactors, the wealthy people who pay their bills in full every month, away from American Express. This would stabilize their revenue and lower their risk profile, leading to a massive re-rating of the stock. The catalysts for this would be positive updates on the closed-loop volume and a successful rollout of new premium card products. In the bearish scenario, the revolving borrowers, those who carry a balance and pay the high interest, start to default at a rate that outpaces the bank's ability to set aside reserves. This would force the bank to pull back on lending, shrinking their growth at the exact moment they need it most to pay for the Discover integration. Traders are also closely watching the regulatory landscape. There's ongoing talk about capping credit card late fees, a move that would hit Capital One's bottom line directly. While the industry has fought these regulations in court, any